So beyond the surface level of the tax advantages it is that you get, is functionally the project that you're investing in sound? Because otherwise it is, tax benefits don't always make tax benefits won't make a shitty project a good project because you get tax benefits. If it's a crappy project, it's a crappy project, regardless of the inherent tax benefits.
What comes to mind when I say debt flow, tax flow, and cash flow?
Yes, right. There's probably better tax advisors than me. I definitely claim to be pretty good looking and really good at debt from a tax advisory standpoint. I'm not your guy. The things it is that I do know is that we do have a tax system. It's favorable for the folks it is that are wanting to and willing to own something. The 1031 side of things it is, and be able to cast that debt down. Love that. One of the things it is that we have seen a lot of times as we moved into more of this principal position in owning and managing funds is that there is it's the best way of doing this, the underneath of things, right? So beyond the surface level of the tax advantages it is that you get, is functionally the project that you're investing in sound? Because otherwise it is, tax benefits don't always make tax benefits won't make a shitty project a good project because you get tax benefits. If it's a crappy project, it's a crappy project, regardless of the inherent tax benefits it is that are there. So one of the things I think it is that you look at from a 1031 or some of these DST funds and things like that are out there, and Brett, you know more about this than me, I'm not pretending to be an expert, is make sure that functionally it is that the endeavor it is that you're investing in is sound, well beyond the inherent tax benefits it is that are usually the precipice of why people are investing.
I couldn't agree with you more. And this is part of why we offer the other DST for exactly that right there, because we believe there's times to have really wise debt. We call it smart debt. And there's times when there's dumb debt, right? Dumb debt is when you're overpaying for the property, the cash flow and the intrinsic value does not make a lot of sense, right? And now you're in a position where the rents or the value appreciation opportunity, you can't really force that. In other words, you're buying, let's say, at the height of the market, 2021, or in this scenario, 2006, right? If you go back to these places where you're going, this doesn't make sense. These values don't make sense, but people are chasing themselves in these 1031 exchanges because their timing is constrained, right? And their tax flow is driving their decisions, which their cash flow are shrinking. And now their debt flow becomes typically, most of the times you do these 1031s, you're taking even more debt on to chase the next deal. The point is the music stops and then people get hurt. It's happening right now, right? Totally. For those who let the tax tail wag the investment dog. Now enter our strategy, Jeremy. I'm curious what you think about this. It's known as the other DST. It's known as a deferred sales trust. We've been telling our clients the last few years to sell high, pay off all of their debt, get out of debt, and put it into actually lending funds, all tax deferred, right? In fact, we placed about 30 million plus with one group in particular that's never not paid 10%, that has a 55% LTV on these deals. First positions with private individuals that have between $5 to $15 million net worth. Personally guaranteeing the loans. They've never lost a single dollar. In other words, we love that investment, and we figured out a way to not have to use a 1031 to go into a lending fund, right? To do exactly what you're talking about. And we try to get the secret out. And we feel like we've been screaming from the top, we've been doing this now a while now, but I feel like most people just don't even know about it. I'm curious, what are your thoughts on a strategy like that?
I'm interested. As soon as we get offline, we're having a whiskey and talking about what we can do together. That sounds great. It's weird because what did you call it? A deferred
sales trust. A deferred sales trust. Mm-hmm.
Right. So rather than a typical DST of a Delaware statutory trust, right? The deferred sales trust. I like that, getting rid of the taxes and then moving into something that is it's income generating. So much of the problem it is that we've had, and a lot of the RAs and the guys that have custodied monies with us really don't understand the back end of this stuff, is that most of these 1031 funds and DST funds, they're paying 10% to the channel to get old rich guys dollars, RAs dollars, right? And so when you look at it, you're paying some BD 10% that shows up as a load to the fund in order to get in there. And then you wonder why it is that the returns of why the lockup is 7 to 10 years and why the returns of the funds are so shitty the first 3 years is because they have to catch up all that cost of capital that it costs them to get your dollars. And so being able to remedy or remove that cost of customer acquisition and be smarter in that whole thing. If you figured out a way to do that, yes, I'll sing it from the rooftops with you.
Yeah, and let's talk about that, right? Because the Delaware Statutory Trust, we call those blockbuster methods. 1031 is blockbuster, and the Delaware blockbuster 1031 is another form of blockbuster where you're forcing yourself on investment real estate to go into a passive deal, typically, right, with a proven operator that has beautiful properties, beautiful brochures, huge fees. I've heard as much as 14 to 15 cents of every dollar is on the load there, right? And the returns around maybe 5%. Let's just say that's the money, but you have no control, no liquidity, no diversification. They're typically tied up for 7 to 10 years. And you're right. Like, I call it sleepy mailbox money. Like, if you really just want to just completely not think about anything, this can be a decent thing. But if you look at inflation and where we're going, I can't do it. I mean, we still do them for sometimes. There's a place for them, by the way, debt over basis issues to replace. They have Amazon coupon deals where 80% LTV, and we'll use that to replace the debt over basis and then put the rest of it into the deferred sales trust. And so it's really knowing the tool and what it's going to solve for. I just think sometimes people think that 1031 is the hammer that solves every problem. When you need a screwdriver, you need a chainsaw, you need something else, and they just keep thinking it's just this 1031 is the only way to do it. Let alone the Delaware and the 1031. As a reminder, everybody, it only works for investment real estate. It does not work for cryptocurrency. It does not work for business sales. It does not work for primary homes. It doesn't work for a lot of these deals that are a little more complex with multiple partners. We just did a $13 million exit for a client out in San Diego. And for them, Jeremy, they had 4 partners. One wanted out, and they buy land for about $500,000. They improve the property $3.5 million. So now they're in it at 4. They sell for 13.5, where they're in the business of developing, not in the business of buying $13.5 million car washes, right? They want to go develop them and make that gap there. And so the 1031 forces you to have to buy equal or greater value, go into perhaps bad debt at the time. And they're so happy now. We did this deal in about mid 2021. And they're thrilled. Like, they're out of debt. We're diversified. We're semi-liquid. A lot of the funds that we work with are either, you can put it in the stock market if you want. We're not big stock market people, but you can put it in T-bills at 5%. But you can get this safe harbor. And then you can invest when it makes sense, right? When the discounts of the values. I mean, 2008 to 2011, as you remember, Jeremy, it took 3 years for the real estate market to really drop, right, to its bottoms.